David Bahnsen joins us. He's the Chief Investment Officer over at the Bahnsen Group. David, great to have you here. Make sense of this for me, right? I understand the sentiment shift, right? The idea is that we were walking into, at least with China, 145% tariffs. At least right now, we're looking at somewhere around 30% and maybe potentially a negotiated solution that's lower than that. That's positive, right?
Of course it is, but let's be clear. We were not going into 145% tariffs to China. We were going into a trade embargo. We were going into no trade.
Okay.
So the difference between 145 and 30 is one of them has no trade, one of them has some trade. That's it. Now, there is a higher cost than before, but when we say sentiment is pushing things a little higher today, that's true. But sentiments will push things lower before, too. Markets are always and forever a discounting mechanism. They're pricing in today what they have to believe about the future, and sometimes what it believes about the future is uncertainty.
Yeah.
There's a little more certainty now. I, for one, think the biggest issue for me is that I believe the first Trump administration included a Trump market put, and that we began to question in March and especially in early April if that market put was gone, and that market put is not gone. He cares deeply what markets think about him. The undefeated politician in this country is market discipline. It works bipartisan. Every president is chastened by markets. It's happened again.
And I think that's your comments probably ratified, but I think the sort of tour that Scott Bessent has been taking over the past few days and weeks to really sort of address investors directly. And I do wonder that as we sort of get these agreements in principle at least, and in whatever months that have to follow in order to work out an actual hard deal, is the market going to be patient enough for that?
Well, we'll see, because we're going to get economic data in the meantime that is lagging right now from activity that didn't happen in April into early May. I'm looking at it from a small business standpoint. 77% of job openings in this country are with companies that have less than 250 employees. There's only 2 or 3% job openings with companies over 5,000 employees. So the bottom line is small businesses are who I think got hurt by this the most, and I very much hope that trade reopens, and especially those that need imports to finish manufacturing in the United States. It's a big untold story here, as a lot of our imports are to then finish goods in the United States. I think that they need certainty, and that was going to show up in the labor data.
And certainty versus and not worst case scenario are two totally different things. Like maybe we now know what the top and the bottom is. We don't know where we're going to settle out. So in that environment, what stocks do you like?
Well, it isn't that I'm picking stocks based on that environment. I'm picking stocks based on the confidence in companies to navigate any environment.
Okay.
So to me, but people say, like, okay, if this pharma deal that President Trump announced is really bad, does that mean you go sell Merck? I say no. I would have never owned Merck if I didn't believe if I didn't have confidence in them to navigate through things. Bad things are always going to happen, and there is going to be an outcome here that is not perfect. The question is what companies have the balance sheet, have the business model, have the management, have the track record to navigate through it. And then for us, we use dividend growing stocks to measure companies' own confidence in their ability to do that.
Give me some examples.
So I already said Merck is a pharmaceutical example. We're very big believers in IBM and Texas Instruments. We love old tech companies. I'm not trying to be cool with my stock picking, that's for sure. On the financial side, we very much like Blackstone and Blue Owl. So there's a diverse set of names. We only own about 30 companies at any one time, but that's why we want them. We want to believe that they're putting their free cash flow to work for shareholders.
This gets to a question, though, too, and I understand. It's a great point that you make about this idea that you're basically owning things that you would have owned anyway and staying away from things that you would have stayed away from. How much clarity, though, do you have in being able to sort of, I guess, model out that discounting, right? Because if I'm to believe this expansion in multiples that we've seen over the last, a few weeks here, is there a sense here that corporate bottom lines will actually follow through on these forward pricing that we're seeing in the market?
I don't believe there is, but I think that most of that excess valuation is in 10 names. And to me, if you pretend April 2nd through today never happened, the whole period never happened, you had a 22 times forward multiple S&P and you have a 40 times forward multiple Mag 7. And I don't think it's sustainable. The problem is I can't use that as a timing vehicle. We don't own those names, but do I believe that in theory those multiples could stay elevated longer than I think they should? Yes. It's a market vulnerability, though. You enter at an excess valuation, it comes out of your future return always.
Is there a sense, though, that you'll see the market gravitate to exactly those names you talked about, because some of those names with the higher multiples, they have those higher multiples because they were seen not just as growth stocks, but also as safety plays to a certain extent. Big cash generators, a track record of profitability, and CEOs that at least seem to have some ability to navigate a political environment.
I understand what you're saying, but I lived through the 1990s, early 2000s as a early professional investor, and I will never say that companies at 80-time PEs are safety plays. And I know that that's how the market was viewing it, but the market and certain investors in the market were doing that fallaciously. And I think ultimately it takes time for lessons to get learned, but that's a lesson some people were going to learn the hard way. NVIDIA correcting 40% was a good thing to teach the people who bought NVIDIA that think I'm entitled to 50% returns per year, that this is not the way the world works. So now for NVIDIA to be right-sized was a good thing. It's still very expensive. Maybe it grows more into a valuation, maybe it doesn't. But I'm sorry, $3 trillion companies do not become $6 trillion companies as easily as they went from $300 billion to $3 trillion. The last 10 years is not going to be the model for the next 10 years because of math.
Because of that math and, of course, the oscillations in between. David, I have to leave it there. David Bahnsen is Chief Investment Officer over at the Bahnsen Group.